So this is just the disclosures tab. I'll give you guys a couple minutes to read through this. Basically, it's based with QSO that I'm employed by QSO Financial Services as well. They carry my license. But take a minute, read through it for me. Okay, so as you approach retirement, when to claim your Social Security retirement benefit is one of the biggest financial decisions you'll have to make. Should you begin receiving benefits at your full retirement age, which is between 66 and 67, depending on your year of birth, or should you begin receiving a smaller monthly benefit before your full retirement age, which can be done as early as age 62, or should you wait past full retirement age to receive a larger monthly benefit, which you can delay receiving benefits up to age 70. As important as your decision is, there is no one-size-fits-all, so it's a matter of personal decision. Of course, sometimes the answer is simple. You may have to claim Social Security as early as possible if you need Social Security income right away to meet day-to-day living expenses, perhaps because of illness, disability, or unemployment. But if that's not the case, if you have other sources of retirement income or you want to continue working, for example, you'll want to take the time to make an informed, well-reasoned decision about your Social Security benefits. If you're like most people, you've paid into Social Security system for years and you'd like to get the most out of it that you can. So to start, here are two major reasons why you claim Social Security is so important. First, when you claim benefits can significantly affect your overall retirement income. With pensions disappearing, Social Security remains the major source of guaranteed lifetime retirement income for most Americans. Once you apply, your retirement benefit will be locked in for the remainder of your life. In most circumstances, not counting annual inflation adjustments or recalculations to account for additional work, so taking time to explore your options now can help you make sure that you have enough retirement income later. The timing of benefits can also affect your spouse, because he or she may be entitled to receive spousal retirement benefits and survivor benefits based on the amount you receive. There's a lot to consider as you make your decision. Here are some of the factors that this presentation will discuss. Your full retirement age and how your benefit is calculated, the amount of your future retirement benefit and the effect of taking benefits early or late, how many years you expect to spend in retirement based on life expectancy, whether you plan to continue working, your other retirement income sources, your income tax picture, and how your decision will affect your spouse and the benefits he or she receives. So let's start with the two basic things you need to know as you begin to explore your options. First, what is your full retirement age? It's the age at which you can receive a full or unreduced Social Security retirement benefit. Your full retirement age ranges from 66 to 67, depending on the year you were born. As shown on this chart, if you begin receiving benefits earlier than this age, you'll receive a reduced benefit. If you begin receiving benefits after this age, you'll receive a higher benefit because you will earn delayed retirement credits. Other benefits that you or your family members can receive are also based on what you're eligible to receive at your full retirement age. The second thing you'll want to understand is how your full retirement benefit is calculated. The benefit calculation is complicated and beyond the scope of this presentation, but here's a brief overview. Your Social Security retirement benefit is based on the number of years you've been working and your earnings over those years. To qualify for Social Security retirement benefits, you must have worked at least 10 years in Social Security covered employment. When you become eligible for benefits at age 62, the Social Security Administration calculates your full retirement benefit. Your highest 35 years of earnings are indexed to adjust for inflation, then they are average. Finally, a formula is applied to determine what's called your full retirement benefit. You may also hear your full retirement benefit referred to as your basic benefit or primary insurance amount. If you retire at full retirement age, you will receive 100% of this amount. But if you begin receiving your retirement benefit early, your benefit will be reduced by a certain percentage for each month you receive benefits early. So let's take a closer look at how much you'll receive if you want to start receiving benefits earlier than your full retirement age. Currently, the earliest age at which you can receive Social Security retirement benefits is 62, but choosing to claim benefits early has financial consequences because it will permanently reduce the amount you'll receive. Your benefit is reduced by a certain percentage for each month you receive benefits early. If your full retirement age is 66, this equates to a 25% benefit reduction at age 62. If your full retirement age is 67, this equates to a 30% reduction. Here's an example. Let's say your full retirement age is 66 and you decide to apply for benefits at age 62. Your benefit will be 25% less than it would be at age 66. As this chart shows, at $1,800 monthly benefit taken at age 66 will be reduced by 25% to $1,350 if taken at age 62 instead. However, you'll receive benefits for a longer period of time, 48 to 60 months longer, than if you begin receiving benefits at your full retirement age, and this is certainly a big factor. This will be discussed later, but first let's look how benefits will be affected if you decide to delay retirement instead. If you delay receiving Social Security benefits, you'll receive delayed retirement credits that will permanently increase your benefit. Your benefit will increase for each month you delay receiving benefits, or 8% per year, past your full retirement age, up until age 70. Note that we are only talking about benefits based on your own earnings record. You won't receive delayed retirement credits for survivor benefits or spousal benefits. To continue with the example from the previous slide, if your full retirement age is 66 and you decide to delay receiving benefits until age 70, your benefit at age 70 will be 32% more than at age 66. As this chart shows, for each year you delay, an $1,800 monthly benefit taken at age 66 will increase by $144 per month and will be worth $2,376 if taken at age 70 instead. This final chart shows the range of monthly benefits you might receive if your full retirement benefit at age 66 is $1,800. Depending on when you choose to begin receiving benefits, in our hypothetical example, if $1,800 is the full retirement benefit at age 66, the monthly benefit of $2,376 at age 70 is 76% more than the monthly benefit of $1,350 taken at age 62, which is a big increase. However, what this chart doesn't show is that you'll receive benefits for 8 years longer if you claim them at age 62 rather than age 70, and that can add up to a lot of money as well. In this example, if you receive $1,350 benefit for 8 years, you would have received $129,600 by age 70, not including any cost of living adjustments. So we return to the fundamental question: is it better to opt for a smaller benefit at age 62 but receive it for a longer period of time, or is it better to claim at age 70 to receive the highest monthly benefit possible? Again, there's no one-size-fits-all answer. In part, it depends on how long you can afford to delay receiving benefits and on how long you expect retirement to last. So how long will retirement last? There's no way to know for sure, but retirement may last longer than you think. According to Social Security Administration Office, 1 in 3 retirees will live to be age 90, with 1 in 7 living to be age 95. So you may even want to plan for this maximum lifespan to reduce the risk that you'll live longer than you expect and simply run out of money. For example, if you wait a few years to claim benefits, you'll receive a higher monthly benefit for life. And remember, because you'll receive annual cost of living adjustments, if price rises, your benefit will generally keep pace with inflation, unlike most other sources of retirement income. If you're married, you'll need to consider the joint life expectancies of you and your spouse, which will often differ from your individual life expectancies. If you're thinking about working well into your 60s and 70s to increase your retirement savings, you may be wondering whether you can receive your Social Security benefits while you continue to work. The answer is yes. Many people choose to apply for Social Security benefits before they actually retire. But as you may have heard, earnings from work may affect your Social Security benefit if you're under full retirement age. If you're under full retirement age and your earnings exceed a certain amount, called the annual earnings limit, part of your benefit will be withheld, reducing the amount you receive from Social Security. But once you reach full retirement age, you can work and collect full Social Security benefits. Earnings from a job won't affect your benefit at all. If you're under full retirement age, the rule is $1 in benefits will be withheld for every $2 you earn over the annual earnings limit. This limit generally changes every year, but in 2018, the limit is $17,040. In the year you reach full retirement age, a special rule applies. $1 in benefits will be withheld for every $3 you earn over the annual earnings limit. In 2018, this limit is $45,360. And then as mentioned earlier, at or after full retirement age, earnings will not affect your benefit. However, to clear up a common misconception, you're not actually losing your benefit because you choose to work, so you don't need to try to limit your earnings. If some of your benefits are withheld, you'll receive a higher monthly benefit at full retirement age, because the Social Security Administration will recalculate your benefit every year and give you credit for any of those earnings that are withheld. So the effect working will have on your benefits is only temporary, and any additional earnings you have may actually increase your benefit later. The Social Security Administration website has a tool called the Retirement Earnings Test Calculator that you can use to see how earnings before retirement age might affect your benefit. One of the most important factors to consider as you decide when to begin receiving Social Security benefits is how your decision will affect your overall retirement income plan. Most people have several sources of retirement income, including Social Security benefits, income from savings and investments, earnings from a job, and pension benefits. How much retirement income do you need, and how does Social Security fit into that plan? If you have less than adequate retirement savings or no pension, you may need to rely more heavily on your Social Security income, leading you to claim benefits early if you need retirement income as soon as possible. Or conversely, encouraging you to postpone claiming benefits so that you can earn the highest benefit possible. But if you have been able to accumulate substantial retirement assets, you may have more flexibility when it comes to timing your Social Security benefits. For example, it's possible that claiming your Social Security benefits sooner rather than later will allow you to delay withdrawing funds from tax-advantaged investments such as 401k plans, 403b plans, or traditional IRAs, allowing them to accumulate tax-deferred a bit longer. Alternatively, tapping other retirement assets first may allow you to postpone claiming Social Security benefits, thereby allowing you to accrue delayed retirement credits. Taxes may also be a consideration. Depending on what income you have in addition to your Social Security benefit, now taxes aren't going to be a big concern for everyone. If you have little or no income other than Social Security, then your Social Security income generally won't be taxable. However, one second here. However, if you have income from sources other than Social Security, you may end up having to pay federal income taxes on your benefit. As shown on the chart, between 50% to 85% of the Social Security benefit may be taxable, depending on your combined income from Social Security and other sources and your tax filing status. So, for example, let's say you're single and you collect Social Security benefit of $20,000 per year and have $35,000 in earnings from a job. Up to 85% of your benefit may be taxable because your adjusted gross income plus 1/2 of your Social Security income is greater than $34,000 per year. The important point to remember is that when you're making your decision about when to begin receiving your Social Security benefits, federal and, in some cases, state income taxes may be consideration if you have substantial taxable income such as earned income, taxable pension income, or investment income. The one thing that it doesn't state here that I want to make sure that you guys are aware of, that is taxed at your income bracket. So the 85% would be taxed at your current income bracket. It's not, your Social Security is not being taxed at 85%. If you're married, there's another important question you'll need to ask before you decide when to claim benefits. How will my decision affect my spouse? That's because when you begin receiving your retirement benefit, it can dramatically affect your spouse's benefit during retirement and thus your household income. Your decision can also affect any survivor benefits your spouse may be entitled to, and your spouse has decisions to make too. Together, you'll need to consider what the most appropriate combination of claiming ages is based on your ages, earnings, and life expectancies. Other people, such as your dependent children or a former spouse, may also be eligible for benefits based on your earnings record, but the rules are a bit different and they're not covered in this presentation. When you're married and both you and your spouse have worked in jobs covered by Social Security, each of you may be entitled to retirement benefits based on your own earnings record. As you'll recall, at your full retirement age, you're entitled to receive 100% of your full retirement benefit, and that can receive reduced benefits as early as age 62. You or your spouse may also be entitled to spousal benefits. For example, if your spouse has had low lifetime earnings, he or she may be entitled to a spousal benefit based on your earnings record that is larger than a retirement benefit based on his or her own earnings record. At your spouse's full retirement age, this spousal benefit will generally equal 50% of your full retirement benefit. However, that amount will be reduced if your spouse files early. For example, if your spouse's full retirement age is 66 and he or she files at age 62, your spouse will receive only 35% of your full retirement benefit amount. This reduction is permanent, so it's important to carefully consider the implications of filing early. And keep in mind that your spouse can't collect spousal benefits until you have filed for your retirement benefits. In addition to retirement benefits and spousal benefits, married couples must consider survivor benefits. When you claim your Social Security benefit can greatly affect the amount of income available to your spouse should you die. Because your surviving spouse will generally receive the benefit that you were receiving at the time of your death, unless your spouse is already receiving a higher benefit based on his or her own earnings record. If your spouse's life expectancy is much longer than yours, this can be an especially important consideration. Survivor benefits may be payable as early as age 60. However, a benefit reduction will apply if the surviving spouse begins collecting a survivor's benefit between age 60 and his or her full retirement age. So here's a hypothetical example that illustrates why it's important for spouses to carefully choose when to begin receiving Social Security retirement benefits. In this example, both spouses are able to claim benefits based on their own records. Spousal benefits are not considered. As this table shows, if both spouses choose to claim benefits at age 62, their joint monthly income will be $2,784. But if both spouses wait until age 70, their joint monthly income will increase to $5,241, which is a difference of $2,457 per month, which also equates to a rough almost $30,000 per year. In addition, by waiting longer to claim retirement benefits, Spouse 1 may also substantially increase Spouse 2's monthly survivor benefit. Since Social Security generally pays the surviving spouse the larger of his or her own retirement benefit or the benefit his or her spouse had been receiving. Of course, this is just an illustration and does not take into account the other factors that this hypothetical couple might need to consider, and your own situation and overall income plan will be unique. So you may have heard that the new rule included in legislation passed at the end of 2015 effectively eliminated the Social Security claiming strategies that couples were using to maximize their Social Security income. However, one of these claiming strategies is still available to some individuals who were grandfathered in under the old rules. If you were born on or before January 1st, 1954 and meet certain requirements, you still potentially have a limited window of opportunity to take advantage of a claiming strategy called filing a restricted application for spousal benefits. This strategy allows you to collect a spousal benefit at full retirement age, then later collect your own worker benefit. Here's how the strategy typically works for those who still qualify. Assume that you are eligible for Social Security retirement benefits or your spouse's earning records. This is your spousal benefit, and on your own earnings record. This is your worker benefit. Once you reach full retirement age, which it will go with 66, you may opt to file a restricted application for spousal benefits. If your spouse has already filed for his or her own worker benefit, this allows you to collect spousal benefits and postpone receiving your own worker benefit in order to accumulate delayed retirement credits on your own benefit. This may help you maximize your joint Social Security retirement income because delayed retirement credits will increase your benefit by approximately 8% for each year you wait, up until age 70. This strategy also potentially increases the survivor's Social Security benefit should the higher earning spouse die first. Remember, upon the death of a spouse, the surviving spouse is generally entitled to receive the greater of his or her own benefit, or the benefit his or her spouse was receiving. So let's look at an example for this concept. One spouse, let's call her Diane, files first for retirement benefits based on her own earnings record. Then, at his full retirement age, the other spouse, let's call him Mike, files a restricted application for spousal benefits based on Diane's record. Then later, at age 70, Mike switches over to his own benefit, which is now 32% more than it would have been at full retirement age. Due to delayed retirement credits, by using this strategy, Diane and Mike have increased their joint monthly Social Security income and have potentially increased the survivor benefit available to Diane, assuming that Mike dies first and that his benefit was higher than hers. Again, filing a restricted application isn't available to everyone. Remember, you need to meet certain requirements. You must have been born on or before January 1st, 1954. You can only use the strategy once you reach full retirement age of age 66, and your spouse must have already filed for retirement benefits based on his or her own earnings record. Note that the spouse who files first in this strategy doesn't need to have reached full retirement age. But even if it is an option, the restricted application strategy isn't right for everyone. You'll need to consider factors such as age differences, benefit differences, and other sources of retirement income, life expectancy, and income taxes when deciding whether to use this strategy. So in this presentation, we have explored some of the major questions that you'll want to consider as you decide when to begin receiving Social Security benefits. To recap, here are some of the reasons you may decide to claim benefits earlier, as well as some of the reasons why you might decide to claim benefits later. Remember, ultimately the choice is yours. It's up to you based on your unique needs and circumstances. Retirement can be an exciting time, but it can also come with financial challenges. When you're ready to make decisions about your Social Security benefits, take time to explore all your options. As a starting point, if you haven't already done so, I urge you to go to the Social Security website where you have a couple of relatively easy ways to estimate your retirement benefits you might receive. First, you can sign up to access your Social Security statement online so that you can view your actual earnings record and what you can expect to receive under current law if you apply at age 62, at full retirement age, and at age 70. If you're already age 60, you also have the option of receiving this statement in the mail every year, about 3 months before your birthday. The second way to estimate your Social Security benefits is to use the Social Security Administrator's Retirement Estimator, which is also available at the website. This calculator allows you to input various scenarios based on current law to estimate your future benefits. And as you near age 62, you should also contact the Social Security Administration to discuss your options. Representatives are not allowed to give you advice about when to start your benefits, but they will be happy to explain your options and rules that apply. When it comes time to apply for Social Security benefits, you can do that online, by phone, or in person. Small steps can enhance your financial life one day at a time, and questions are always welcomed.